Hey, what's up? Happy Monday. Quick market update. Mortgage-backed securities are kind of trending in a wide range between 0 and down 20 basis points. I actually had one of these already recorded in the can and ready to go for Monday morning that I did on Saturday, and that just went. And with the news that came in over the weekend, Saudi Arabia is cutting oil production, and I guess this has is due in large part to the United States' failure to still yet, as of yet, refill the strategic oil reserve. So the bad part here is that may lead to a spike in energy prices, which may also feed negatively into our inflation reporting. I got to say, it's like there's some cosmic force in the universe that just does not want inflation to come down and wants mortgage rates to be high forever. It's been really, really frustrating. My heartfelt, sincere, shared frustration goes out to everyone out there, whether you're an agent, someone trying to buy a house, or a fellow mortgage professional. It has just been brutal. Every prediction we make just seems to get thwarted by some kind of cosmic happenstance. So, most recently we have it here with what's going on in oil and energy prices. And last week, it was the BLS jobs report. We had started to gain back a little of the ground we'd lost over the last 3 weeks, and then bang, Friday, we just got clobbered again. And I have no problem going on record and saying that I think these last 6 months of BLS jobs reports are just absolute nonsense. Historically speaking, when Jobs Week comes out, you've got Wednesday's the ADP jobs report and Friday's the BLS report, the Bureau of Labor and Statistics. And there's usually a lot more congruence between those reports. And we're just seeing this wild departures month after month where, despite a very, very tough economy, a very tough job economy, somehow, some way, these reports are continuing to beat expectations in job creation. And it's these headline numbers that the markets are reacting to, not realizing that some of these reports, even where they're beating expectations, that 90% of the jobs being created are part-time jobs. That's not exactly a sign of a robust and thriving economy. But again, the headlines move markets a lot more than we'd like them to, and we're just going to have to deal with it. With that said, we're kind of in a familiar pattern here where we're just waiting on the next CPI report to see if this finally gives us a push in the right direction. That's coming up on June 13th, and coincidentally, the following day, we're also going to have an announcement in the press conference in the Fed telling us whether or not they plan to take a pause or hike an additional 25 basis points. A month ago, it was 0% chance we were going to see a hike in this meeting, and I've seen that chance go as high as somewhere between 40 and 60% that we might actually see another 25 basis point rate hike. I'm hoping we don't. I'm hoping that the CPI coming out the day before, maybe if it needs to save us, does save us. But from my vantage point, after just seeing prediction after prediction just not come to pass, for me, I'm just cementing myself in a very conservative stance. And I'm not going to really feel comfortable about seeing rates come down or predicting they're going to come down until I see us start to get closer to the levels of resistance that we're fighting. And I'll show you these in the chart real quick. If you look here, you just see we're under the 25, 50, 100, and 200-day moving averages. All of them are well above our heads right now. So, if we're going to make any kind of real traction, we've got a long way to go. To show you another chart real quick here, on the positive side of things, with the 10-year Treasury, which is kind of the inverse of mortgage-backed securities right now, at least there is kind of a Fibonacci level that is holding, that is providing some kind of resistance to Treasury yields getting any higher, which hopefully serves as a floor of support for mortgage bonds. We'll see how that goes. That's really the only thing I'm taking any solace in. Other than that, we're really just waiting and, I hate to say it, hoping and praying for a really good CPI report. So that's it as far as markets go. Another thing I wanted to hint on real quick, buy downs. So I think at the beginning of the spring, or at least heading into it, we'd all kind of forgot about buy downs. We were talking about those, Q4 last year when things were starting to slow down and, properties, DOMs were going up a little bit. But, now that we're right back where we were, hyper competitive, limited inventory, still a high buyer appetite, there's buyers out there and their stance is changing. They went from, I don't care if I get the house at 7% or 6.5%, whatever, I'm going to refinance in a year and I'll be fine. the confidence and faith in that has certainly dwindled with just misprediction after misprediction. And I can't blame people for feeling that way. So more people are asking me about buy downs. A buy down is in short, is just a way of temporarily buying your interest rate down, so that, let's use for an example a 2-1 buy down. So 2-1 buy down means if you qualify for a 7% interest rate, you can use a credit, whether it's yourself or the seller, depending on the scenario, a credit to buy that rate down temporarily, so that for year one, your rate will actually be 5%. And for year two, it'll be 6%. And then year three, if you're still in that loan, you go to that 7% payment. The idea is it's a good way to buy down the rate, minimize your out of pocket costs, and also maximize your affordability, and to do it in a way that gives you a little more time to refinance if rates don't drop as quickly as we're hoping they were going to do. If there's a little more time on the clock and that's going to take a year or a couple of years further out, this is another alternative. So it's not a perfect situation. It's good for some people. It's not good for others. It's not a panacea by any means, but it is an option worth evaluating. So if you have any questions, I have multiple lenders I work with who offer them. Happy to go through the details with you anytime. That's it for me this week. I hope you have a great week. And if there's anything I can do to help, feel free to reach out. Take care.